Hey, welcome back to Everything Money. We're glad you joined us again. As always, it's Seth, Paul, and handsome Mo. Mo is the most handsome of all three, wouldn't you think? I mean,
He's very handsome.
Yeah, he works out the most. And but anyway, I sort of look like Chewbacca, and you're definitely in the middle handsomeness, I would say. Today we're talking about options, writing covered calls, puts. This is Paul. What kind of level do you have to be in your investing journey to move into options? Because for me, at the moment, it's still a bit over my head. I mean, I've controlled so. What is my journey? You know, I invested in a bunch of BS. I mean, frankly, I'm glad I put money in, but it was in a lot of poorly selected companies that actually did well for me, but regardless. And then I moved into like learning from you. I moved into my little book stocks. So I'm actually picking my own ETFs, following great companies. And now I'd like to move in. I foresee in the future me sitting down with you guys on a daily basis and writing options. Where is a normal investor? When would they finally start turning and doing something like this?
So one of the first things is there are ways to use options to sell puts and sell covered calls, even if you don't have 100 share blocks. But most people should wait until they have 100 shares of a stock at a time, okay? Now, that's not everybody out there, but it's good to understand this because when the time is right, this isn't complicated. Maybe it is a little complicated, but it's a very simple process. I use options to generate income when trying to buy companies I want at prices I want. And then when I own the shares, try to sell calls on positions I currently have to generate income on them, okay? We're gonna explain that a little bit here to show what we're talking about, but the bottom line is there's great ways to use options to generate income. Most people buy options. The most common question I get is, Paul, on your options, are you buying or selling? I sell 99% of the options I have are sold. It's kind of this unwritten rule that if you're buying options, you're kind of the sucker. That doesn't mean you are a sucker, but I've bought options before. I know people who buy options. They tend to be deep value investors who are using options as a way to make big, long tail events, like black swan events to hedge against that, right? Mm-hmm. But when it comes to selling, we use the selling of options in order to generate income for our portfolio. And this can be very successful. I always tell people, if I just match the market in the performance, options alone will make me 2 to 5% a year above and beyond. Where if you do the math, it's an incredible amount. And that's why I always tell people, don't emulate my investments because I use options as a way to generate income and beat the market.
So Paul, to put this in layman's terms, is we are basically writing contracts to pick up or sell stocks at a future date for prices that we deem where we want to acquire them or get rid of them.
That is 100% correct.
And we get paid to do this.
We get paid to wait.
And the point of all this, folks, as I was explaining to someone, a very new investor in my driveway while I was shooting hoops, is if you can transition your return over a lifetime, even 1%, is astronomical gains on the back end, right, Paul?
Absolutely. And you know, our software has the retirement calculator where you can sit there and look and say, you know, Seth's 40, if he retires at 70, 1% a year between now and 70 is a huge amount of money. Huge amount of money. Now, the key though is you have to understand what you're buying or selling your stock for and why. That is the fundamental reason. If you're just randomly doing it, there's no rhyme or reason to the values, you're gonna end up getting hurt. What we do is we sell options on companies at prices we want the companies at, and we sell covered calls on the companies at prices we're okay losing them at. That is the key there, okay? So to bring up an example, let's talk about a big company like Microsoft. Mm-hmm. Microsoft's currently at $287 a share. Let's say, and I'm using hypotheticals here. I'm not saying Microsoft's worth this or not. I do think Microsoft's overpriced. But let's say I thought Microsoft was worth $250 a share, okay? What I would do is I would go out and look at the price of puts on Microsoft at $250 a share at some date in the future. Okay, so what date in the future? Let's pick somewhere out further, September 24th. So I'm going to unselect all, select September. And by the way, this is Schwab, which I use. Mm-hmm. I'm going to pick Microsoft at $250 a share. So I'm on Schwab right now because I like their system. I'm not showing a bias as anything. Do whatever you want. Love whatever you want. Don't care. I'm picking September 24th, 2021. I go here to puts. I go to $250 a share. It is right here. Boom. So right now it's selling for between 78 cents and 87 cents. What I would do here is I would sit there, and the other thing to look at is delta. What does delta mean? Delta is the chance of this happening. Right now, according to all the numbers, there's a 6.6% chance that on September 24th, which is 45 days from now, Microsoft will be selling at or below $250 a share. So let's pick 80 cents here. What this allows me to do is, since somewhere in the middle, I'm going to get 80 cents. Somebody's going to pay me 80 cents per share.
Per share, yep.
Per share to give them the right to sell me, to put Microsoft stock in my hands at $250.
And you have to pay them.
No, they pay me.
I'm sorry, you pay them at $250 per share.
So $250 a share. Let's say hypothetically the stock ends up at $260. What happens then, Seth? Well, it's not below $250. So they're not going to force me to buy it. I'd love for them to force me to buy it at $250. I just paid $10 because the stock's at $260. So I keep the 80 cents a share and I write a new contract.
You have to have 25 grand ready to buy to buy.
Now that's the catch. With 100 shares, you have to have 25 grand ready because the bank's going to make you put up collateral, or you can do naked puts, which I do not recommend. Okay. Now let's say the stock is at 240. You might sit there and say, "Oh my God, I lost $10." I don't look at it that way. I look at it at I was going to buy it at 250 whether it hit there or not. The second it hit 250, I was buying it for 250. That's the discipline you need when selling puts. You need to pick a price where the second it hits that price, no matter what day it is, you're buying it. So in my head, yes, I'm going to lose $10 in this trade, but guess what? They paid me 80 cents. So I actually only lost $9.20. You might think no big deal. It's a big deal. I'm being paid to wait. Why would I not want to save money, right? So yes, I theoretically lost $10 because if I just waited instead, I bought it for 240, but that's not the way it works. Most times these never hit the prices. You pick a delta below 15.15, below 15%, 1 in 6 is going to hit. So your goal is to make sure you collect enough premium all around. You're collecting money, and it allows you to build a position over time while collecting income along the way. So again, this may seem complicated. Rewatch the last few minutes of this video. Again, I am selling the option for somebody to make me buy the stock at 250 on September 24th, and they're paying me 80 cents per share to do so. If it ends up above 250, nothing happens. Why? They're not going to force me to buy it at 250 when it's selling for 260.
But you keep the premium.
But I keep the premium. I keep the premium in both situations. This premium, the second one, just decreases my loss. My loss on paper right there. That's it. I basically paid $249.20 instead of $250 for the stock. Okay. And the point is, if you do this over and over again on stocks you want, I would never even blink an eye at this one. I'm like, great, I wanted it at 250, so I bought it at I'm fine. I just saved 80 cents. I'm cool with that.
Who's on the other side of this contract, and what are they thinking?
Don't worry about that, but okay. I will explain to you what it is. It's somebody just making a bet on, hey, I think the stock's going to go below 250 at this point. Because if they're sitting there buying the option for 80 cents, they think the stock's going to go below 250, and they're going to sit there and say, hey, if it goes to 240, I just made $9.20. I made $10 investing 80 cents. That's a 10-to-1 return, a 12-to-1 return. That's their goal. They're making bets on that. Mo.
And at that point where the stock price gets to 240 and that expires and you get placed the shares, then you go and you rewrite and you look at $230 options or $235.
And then you sell covered calls on it too.
And you sell covered calls because now you own the shares at $250. So you can sell covered calls at arbitrarily $275 a share or something like that. So you're actually making money on both sides now.
And that's the goal. Constantly writing puts and calls to constantly generate income. It's a great way if you're older and have a nice portfolio, you can generate income for your own living while still staying invested in the market. Because most people who are older are sitting there, and for those of you who are young and think about retirement, guys, this is a great way to subsidize some living expenses by selling puts and calls.
We have an older patron right now. He has a almost 7-figure portfolio, and he's making $6,000-$7,000 a month. And
yeah, but he just told me the other day he's made 30 grand in the last few months.
And
so he's making 10,000 a month now doing this kind of stuff.
So in the end, if this resonates with you, you might be wondering, how do I pick these prices? And the key is, folks, is if you join our Patreon, you can get access to our software. If you watch any of our other videos, this is the whole gist, is we take a look at companies. Then we use our stock analyzer tool to figure out what we want to pay with them. So these are not blind stabs in the dark, Paul, that you're hoping they're getting. You've come up with a process for saying, I want to be buying Microsoft at this price. So because I've said this to you, like, we've been interested in some companies. I said, should I be buying the stock? He said, well, why don't you write puts for 6 weeks out or write puts for 6 weeks out, and so you can make money while you're waiting to get the stock at a great price.
Especially if the stock isn't at the price you want it yet.
Yeah.
You know, if it's at the price you want, like Alibaba. I recently watched our Alibaba video. I bought I bought stock in Alibaba, but the very first thing I did when I did that was sell puts at lower prices at future dates. And I sold covered calls. So our next order of business is how do you make money when you have a portfolio of stocks? Now, let's go back to the Microsoft example. Let's say we go and we're now looking at calls here. So the idea here is Microsoft's at $287. Let's say hypothetically, I think Microsoft is worth $300. What I would do is I'd go to the calls and I would pick $300 strike price. So right here, $300 calls. First off, the delta is 0.238. What that says is there's a 23.8% chance that Microsoft on September 24th ends up above or at $300 a share. So what are they paying me? Right now, wow, good premium.
Wow.
Call it $2.25.
$2 a share.
$2.19 to $2.37 is the bid and ask. Go somewhere in the middle, $2.25. $2.25 a share. So what does that mean, guys? I can now collect $2.25 for every share. If, really now the stock's at 287 and I'm selling the option at 300. If on September 24th, the stock ends up above 300, somebody can pull my shares away from me at $300. So let's say it ends up at 305. Here's the good news, guys. You made the $2.25 a share and you made every dollar between 287 and 300. All you're sacrificing now is this difference.
So maybe there's a big run up overnight. They announce something and it goes from 299 to 307. You lose that gain.
You lose the extra gain above the 300. That's it. You're still making everything between 207 and 300. You're still keeping the 225. All you lose is the gain above it. Listen, I've had situations where I do this and the stock ends up at 350. And you go, crap. But guess what, guys? Those are few and far between. The goal is if you have a good portfolio or 20 or 30 stocks and you do this on all of them every single month, you can generate some good income, but always be watching it. Always make sure you're comfortable because if you're not comfortable losing the shares at that price, don't do it. The key is to write a call at a price you feel comfortable losing the shares at. I think Microsoft's overpriced at 287. I'll sell the 300 going, hey, if it hits 300, I'll collect it. If not, I just collected almost 1% revenue, 1% of the investment by waiting 45 days. That's a 7-8% return a year.
So to recap, going back to the beginning of this video, if you're selling a put, you don't own the shares, and if you're selling a covered call, you have to have 100 shares of this company.
That's what makes it covered. That's what called the covered part of it is. I'm covering the call with my shares. That's what's going to protect the investment. So it's a great way to generate income, guys, especially in companies that are selling very, very close to your price. The closer your strike price is to the current price, the higher the premium. Let's show you. Let's say you wrote it at 290. Look at this. At 290, guys, they're paying $5.75. But the chances of it hitting is 45%. I'm okay with that. If I think it's worth 290, I will gladly write this all day long. I'm going to make 2% of my money for waiting 45 days. Heck, I'm hoping that I can do this over and over and over again, and Microsoft just stays stagnant at 287 for the rest of the time. I will make 25% of my money year in and year out without even thinking about it. That's not the typical way it happens. But this is how you can use options to generate more money and more return for your portfolio.
So Mo, if you're watching your daily or weekly trends on your charts,
good question.
Do the charts influence your options picks? I'm sure they do.
They do. I'm going to pull up Apple as an example. So these are not, by no means is this lockstep and it's going to work every single time. But for example, my father owns tons of Apple shares right now. So I've been writing options on Apple for the past 18 months. And they still haven't, these are covered calls, and they still haven't been taken away because I just look at it. Apple right now, it cannot break through this $150 area. So I just keep writing $150, $155, $160 over and over and over. And we just keep generating income after income after income. I just wrote some yesterday. I just keep
What'd you get in premium in the 150?
Like
how much?
The 150s, those were 5%.
5% annualized.
Annualized.
Okay, so about a half percent, a little under 0.5% per month.
And I'm doing 30 days
but
out
guys,
of time.
I look at this as basically a dividend for you.
Oh, it is.
So if you look
on top of the dividend they're paying.
Correct. Now you have to be careful to make sure that you don't write these options at a point when the dividend gets executed, because then you can lose. But that's more intricate. The point is, guys, if they're paying you a 2% dividend, which I don't know what Apple's paying right now.
It's like 1.8, I think.
But you can generate another 4 or 5%. You're basically paying yourself a 5 to 6% dividend yield on Apple day in and day out. And again, this is about doing it over a portfolio of companies that you can do over and over and over again. Sometimes you'll lose them, sometimes you won't. The bottom line is over long periods of time, there are people I know who make 10 to 20% a year just off of selling covered calls. So imagine they make 12% return on their stocks and they're making an extra 10 to 20% a year. Guys, it's game over.
Yeah. How could you coach up our new investors? Like, again, I go back to what point would you switch to being an options trader, and how much money do you think?
Yeah, it's not about switching. It's about adding this tool to your investment strategy. Yeah. That's all it is. We're not switching you to options. We're sitting there saying, hey, you have a great basket of stocks. Now go use that basket to go make money.
And I say this every morning on the morning show when prompted, but I think that you should learn trading if you have $0, so you can use that tool. You should learn options when you have not enough money to generate 100 shares per stock. So when you have that money, you have that tool in your arsenal. So I think that answers your question.
Yeah, that really resonates with me, Mo, on the morning show. Mo goes live every morning at 9 a.m. You said, it's funny, it's like, why don't you learn now? And maybe 4 years from now, you're an incredible options trader. I have thought about, gosh, we go to school from like 6 to 20 something, and then we don't implement the things we learn until our mid-20s. Yeah. For me, our 40s.
Well, by the way, just so that you know, we didn't implement anything because we didn't learn anything in school, but go ahead.
And then so like, let's gather this. You're speaking to me, Mo, when I'm watching the show. It's like, let's practice this now, even if it's paper trading.
Yeah.
Like, let's practice and maybe be ready for...
Get the ground running.
Yeah, there you go. So, Paul, the take-home message in terms of options trading is like, how would you sum it up for our new viewers?
Go learn it now, even if you don't have 100 shares of stock. It's a great way to generate income and extra return. And it's actually fun too, guys. Like, it's actually fun to watch the options, write them month in, month out, check how they're doing. Don't worry about the fluctuations in price. It's just... keep looking at them, keep learning, join our Discord. If you join our Discord and join our community, this is gonna be a very big focus for us going forward. We have an event that we're doing in December in Austin where one of the big things we're gonna discuss are options trading because we realize how valuable it is. I wish I'd learned options
years ago.
Oh, I would have made so much money. Yeah. I would have, but either way, I'm glad I'm learning it now at 39 and 40. I won't talk about the exact numbers, but Seth, I've made significant money in the last 13 months doing options on 1/10 of my portfolio. I mean, more money than I made last year, more money than I paid myself last year. So I basically covered all my salary and one of our startups just by doing options.
Well, I see you guys work. You know, we go to the Mexican mansions and you guys fire up the computers in the morning, and the thrill of the chase is kind of fun.
It's so much fun.
By the way, this is a great way,
an exciting level.
So the reason I love it so much too, guys, is if you're one of those people who's like, I need to be doing something. This is a great way to do something while you're learning other things. Learn about value investing. Value investing is very boring. It takes a long time. It's very fulfilling, but idle hands get people doing stupid things. Go do the option stuff. Do most trading because it keeps you busy, keeps you doing something while you're going on. Even for me, Mo, I want to talk to you about doing these charts along the way because I have a bunch of cash sitting on the sidelines. I'm like, well, I might as well generate some income off of it.
Yeah.
So these are the things you need to do with options that can generate income. The great news is when you retire, if you do this now, I don't care how young you are. If you're 20, go learn it now because when you're 60, one, you can probably retire sooner, and two, you can keep your money invested in good companies while you generate your lifestyle along the way.
That's our take on options. Join the Patreon below, fondle the thumbs up, and join Mo in the morning at 9 a.m. Eastern, and you can learn more about this and trading as well. So that's our take. Thanks for watching the video, and we'll see you next time.